Hello there, Prof. Aram here, and in this video we're going to look at Modigliani-Miller's second theory, which is capital structure with corporate taxes. If you recall from the first theory, the theory is structured under a set of very restrictive assumptions, set of sometimes unrealistic assumptions. But the importance of that theory was it provided a framework on what are the things that may be relevant for capital structure. And when we relax those assumptions, we see whether those factors are important or not. So they did that in their second paper. In their second paper, they relaxed the zero tax assumption and they introduced corporate taxes. So let's get to this and see what's the effect of corporate taxes on the capital structure. As you know, corporate tax law allows interest to be deductible, which reduces the taxes paid by firms. So interest is a tax deductible expense, which increases the benefit of borrowing money. Therefore, more cash flow goes to investors and less taxes paid to the government when the firm is using debt, when leverage is used. In other words, debt shields some of the firm's cash flows from taxes. Let's look at an example. Here we have two identical firms. One is levered and the other one is unlevered. So everything is the same in these two firms except how they finance their assets. So that's why we see that both of them have the same earnings, $5,000, but one of them has to pay interest. Let's say they have $6,250 in debt and the interest is 8%. So the amount of debt, the amount of interest is going to be $500. We have $500 here for the interest, which lowers the taxable income of the levered firm. So the total taxes paid by the levered firm is less than the taxes paid by the unlevered firm, and the net income of the levered firm is of course lower because they have to pay this interest. So the total cash flow from assets though for the unlevered firm is $3,300, which is $5,000 taxable income minus the tax. So you have 3,300. For the levered firm, on the other hand, is 4,500 minus 1,530, which is 3,470. As you can see, the cash flow from assets for the levered firm is higher by $170 for the levered firm. So finding the tax shield is very important in this theory. So tax rate times the interest payment gives you how much tax saving you have for each year. So your loan amount is $6,250 with 8% interest. That means every year you pay $500 in interest expense. And if your tax rate is 34%, that means that you're saving $170 every year because of this tax savings, because of the interest tax deductibility. So every year you're going to, and we are assuming we have perpetual debt. That means that every year you're going to save $170 in taxes because you're using debt. This resembles a perpetuity. So the present value of all these annual tax savings is going to be $170 for each year's cash flow divided by the cost of debt, which is going to be $2,125. Or you can just multiply the tax rate with debt. So $6,250 in debt times the tax rate give you the same answer. So this is the present value of tax shield or tax saving for this firm. So the tax shield adds to the value of the firm. The value of the firm increases by the present value of the annual tax shield. So this value of the levered firm is equal to the value of the unlevered firm plus some additional value that comes from the tax saving, present value of interest tax shield. So the value of the levered firm equals the value of the unlevered firm plus the tax savings that comes from borrowing money. RU here is the cost of capital for an unlevered firm. So this is the cost of capital of unlevered, which is the same as rate of return on the assets of the firm for an unlevered firm. To find the value of the levered firm, you need to calculate the value of the unlevered. The value of the unlevered is the after-tax cash flows, EBIT times 1 minus tax rate, discounted at the cost of capital of the unlevered firm. So this is proposition 1. Value of the levered firm increases by the present value of the tax shield. So value of the levered firm is value of the unlevered plus the present value of the tax shield. Remember, if we have 0 taxes, then this will be 0, and then you have value of the levered equals the value of the unlevered, which was Modigliani-Miller first theorem. But here we do have taxes, so we need to add the present value of the tax shield. So in this case, let's say we have 25 million in earnings, 35% tax rate, debt is 75 million, cost of debt is 9%, and the unlevered cost of capital, which is RU, is 12%. So what is the value of the levered firm and what is the value of the equity? To calculate the value of the levered firm, we need the value of the unlevered plus debt times the tax rate. First, we need to find the value of the unlevered firm, which is EBIT times 1 minus the tax rate over RU. So we have 25 times 1 minus 35% times divided by 12%, which should give you 135.42 million. And then the value of the levered firm is going to be 135.42 plus your debt times the tax rate. So 35% of 75 million should be 161.67. This is the value of the firm, and equity is simply value of the levered firm minus debt, which is 161.67 minus 75, which should be 86.67. Again, to find the value of the levered firm, you need to calculate the value of the unlevered first, and then add the present value of the tax shield. So to summarize, Modigliani-Miller showed that the total cash flow to the firm's levered investors is equal to the total cash flow to the firm used investors plus an additional amount due to interest deductibility. The final conclusion here is that if the tax rate, say, is 40%, then for every dollar of debt, you're adding 40 cents to the value of the firm. So given this proposition, how much debt is good? Of course, 100%. The optimal capital structure in this case might be all that 100% debt, because for every dollar of debt, you're adding 40 cents to the value of the firm and you're maximizing value for the shareholders. And this is how we show it in a graph. The value of the unlevered firm is going to stay constant. But as you keep adding debt to the capital structure, the value of the levered firm increases by this interest tax deductibility benefit, or the present value of the tax shield on the debt. If you keep increasing the debt in the firm, the value of the firm will increase as well. The value of the firm will increase linearly with the amount of debt that you are adding to the capital structure. So again, the optimal capital structure in this case is 100% debt, which of course is not realistic, but we'll see why later on in the future videos. And then proposition 2 deals with the cost of capital. We can also conclude that the best capital structure is 100% debt, because with 100% debt, we are minimizing the cost of capital of the firm. Notice that we are adding the 1 minus t terms to the cost of capital and the cost of equity terms here. This is similar to what we had in Modigliani-Miller with 0 taxes, but now we are adding this 1 minus the tax rate terms here. For example, if you have 25 million in EBIT, tax rate is 35, and I mean everything is similar to what we had before. What is the cost of equity and cost of capital here? Cost of equity is, remember the formula was RA minus RD times debt to equity ratio. Now we have 1 minus tax rate. This is the additional term that we have. So see, with additional debt, the cost of equity goes up from 12% to 13.69%. And then weighted average cost of capital goes down from this 12% unlevered cost of capital to 10% cost of capital. So under Modigliani-Miller with taxes proposition 2, cost of capital is decreasing as you keep adding debt to the capital structure. So what happens if the firm changes its capital structure so that the debt to equity ratio becomes 1? In this case, your RE would be 12 plus 12 minus 8 times. So debt to equity ratio becomes 1, and then 1 minus the tax rate of 35%. So you will have 1395. Meaning that if you increase your debt in the capital structure, your cost of equity will increase, which means that your cost of capital should go down now. 50% equity times 1395 plus 50% debt times 8% times 1 minus tax rate of 35. So we get 9.9%. So with increased debt, your cost of equity has increased but your cost of capital has gone down, right? Graphically, it will look like this. If you increase your debt to equity ratio, this horizontal line, if you increase that, your cost of equity will increase as well. Remember this example that we have, right? If you keep adding debt, your risk of your financial risk will, so with higher risk, the equity holders will require higher return. So that's why you see this increase in the cost of equity as you keep adding debt to the capital structure of the firm. But keep in mind that the cost of capital of the firm will decrease in this, right? Also, I mean, your cost of debt now is the after-tax cost of, right? So proposition 2 of Modigliani-Miller with taxes, proposition 2 tells you that as you keep adding debt to the capital structure, you're going to minimize the cost of capital. So again, the ideal or the optimal cost of capital in these circumstances is 100%, right? Here's an example. We have 151.52 in EBIT, 500 in debt. Unlevered cost of capital is 20%, tax rate is 34%, and the cost of debt is 10%. What is the value of the equity? To find the value of the, right, in this case, in a levered firm, you need the value of the levered firm. And to find the value of the levered firm, you need the value of the unlevered firm. So let's start with there. Value of the unlevered is EBIT times 1 minus tax rate over RU, which is going to be 151.52 times 1 minus the tax rate, 34 over 12. So the value of the unlevered firm should be 5, right? And the value of the levered firm is the value of the unlevered plus the tax shield, which is 500 in debt times the tax rate. So value of the unlevered is 650 here. Now you can calculate the value of the equity, which is 650. Sorry, $670. $670 minus 500 in debt, which is going to be $170 in, right? So based on these numbers, what is the cost of equity for this firm? RE is RA or RU in this case plus RA minus RD times debt to equity ratio times 1 minus the tax rate. Remember, RA and RU are the same thing here. RA is the rate of return on the assets of the firm or the business risk of the firm, which is the same as the cost of capital of the unlevered firm, all equity. Okay, so we have 20% plus 20 minus 10 times debt to equity ratio is 500 over 170 times 1 minus the tax rate of 34%. So if you calculate this, you should be getting 39.4% for the cost of, right? And the cost of capital is equity over total value of the firm, 670 times 39.4 plus 500 debt over total value of the firm, 670 times 10% interest on the loan, and then 1 minus the tax rate. So I'm getting 14.92%, which makes sense. You're going from 20% cost of capital to 14.92% because you're adding debt to the capital structure of your firm. I hope you find this video useful, and thanks for watching.